All right. So thank you for those of you who have joined us for today's webinar, focused on mastering compliance and data governance in bank transitions. We have a really great panel lined up for you, led by our moderator and friends at Morrison Foerster. So Jeff, I will turn it over to you to get things started.
Thank you very much, Taylor, and thank you to AFC for bringing us all together. And welcome everyone to today's webinar, where we'll explore a topic that's really becoming critical in the fintech space, which is bank transitions, and really more thinking about it as the evolution of sponsor banking. As Taylor mentioned, I'm Jeff Silberman. I'm a partner at Morrison Foerster. I co-chair our firm's fintech and financial services practices, where I work with sponsor banks and fintechs of all shapes and sizes across a range of products, including deposits, cards, payments, and loans. And that includes setting up programs at banks and assisting with transitions when needed and everything in between. And with us today is a panel of other experts that are well positioned to discuss the topic of program management and transitions, and specifically how both banks and fintechs navigate some of the data complexities that come with moving a program or adding additional bank partners. So maybe with that, I'll hand it off to Brittany for a round of intros.
Thanks, Jeff. Thank you to the American FinTech Council as well. Super excited to have this dialogue and be amongst peers and colleagues and friends. So my name is Brittany Decker. I am the head of our sponsor bank division for North America within Visa. And we look after all things that need banks behind them, any of our partners that need to get access to products and solutions, and own those relationships and business development. So today's discussion is going to be amazing.
Neha, you want to go next?
Yeah. Hello, guys, and thanks for having me. AFC, thanks again. My name is Lee Easton. I am president and founder of Identify. Identify is a large Snowflake partner, and so we work with a number of sponsor banks. Specifically, I wanted to share we've had a couple customers in the last 12 months that have had a large influx of partner requests, which has led me to be a part of this conversation today. And yeah, we recognize that there's a need to build some world-class systems using enterprise solutions like Snowflake, and very excited to be here and talk more about the topic.
I can go next. Hi, everyone. I'm Neha Narkhede. I'm co-founder and CEO at Oscilar. Oscilar is an AI risk decisioning platform that helps banks, fintechs, and credit unions manage onboarding, fraud, credit, and compliance risks. In my previous life, I'm also a repeat technology entrepreneur. I co-founded and served as CTO of Confluent, which is a public company. It went public in 2021, and that is where I got the idea of Oscilar, because we brought real-time data and AI together to solve compliance and fraud problems for a variety of companies, banks, payment providers, merchants. That's where I had first-hand experience working in this space. And that's the reason for starting Oscilar. And today we are serving several banks and helping fintechs and banks collaborate and go through these transitions easily and remain compliant in that process.
Perfect. Thank you, Neha. So I guess before we get into a handful of questions for the panel, let's just maybe quickly set the stage with some high-level macro trends that we feel like are shaping the industry, and that will also shape today's discussion. The first is market growth, and notwithstanding some banks exiting the space and the obvious increased regulatory scrutiny that the sponsor banking, BaaS, and embedded finance markets do remain in growth mode. It's largely as a result of customers, retail and commercial, continuing to seek online and app-based financial products and services. And a major part of that growth is fueled by the collaboration between banks and fintechs. The second, and I briefly mentioned it before, but can't go much further without mentioning again, is second major trend is, of course, increased regulatory scrutiny. And so as regulators are taking a closer look at how bank and fintech partnerships are set up and how they operate. And we've, of course, seen consent orders over the last 12 to 18 months increase. As a result, both banks and fintechs are increasingly scrutinizing program governance, regulatory oversight, risk and data frameworks, and where needed or desired for growth, fintechs are regularly seeking additional bank partners to support their businesses. And third sort of macro trend that we're seeing a lot of is that as our market matures, it's only natural that the depth and expertise and technological support matures with it. And so the third really meaningful trend we're all seeing is on the tech side, where sponsor banks and fintechs alike are making meaningful strategic decisions around their tech stacks and their partnerships, whether that be onboarding, monitoring, or servicing financial products, not just for today, but really making investments for scale of tomorrow. And so in today's session, we'll explore all three of these trends and how each of them are really driving transformation and reshaping our market. And so with that, the chat, I think, should be open. If anybody has any questions as we go through, we'll aggregate them at the end and we'll address with whatever time we have open. And so maybe with that, we'll jump to our first question for the panel. Brittany, Visa sits at the center of many embedded finance ecosystems. And with the recent shift in the sponsor banking landscape, some banks exiting and others seeing an influx of fintech partners, as Lee alluded to, what are some of the major trends that you're noticing and how these partnerships are evolving?
Yeah, it's a great question. Primarily, we're seeing that there is still a trend in interest for banks to take a look at what the space has to offer. So primarily, we've got some impacts, right, that we have to deal with from a day-to-day basis. If a bank decides that they want to change their model, close their doors for net new business, or fully exit the business, but it's leading its way into opportunity for new or existing BIN sponsors to be able to take on the volume that is still left. That's really great, and it's been in the system. So we see that it's only continuing to increase. If you were going to ask me, I think that the future of what payments is going to look like is going to be moving more solidly into what sponsorship is. So in evidence of that, we do see like a new entrance, like a Fifth Third, who has started to sign new business and publicly making those announcements in issuing and then acquiring and then money movement, and all different kinds of other banking services that they have, that they recognize that there's an opportunity for them to diversify their revenue models, which has been increasingly important, especially after we've come into a position of not having deposits really mean very much several years ago during our COVID scenario with interest rates being zero, to now seeing that the deposits are much more interesting as well. So we have a lot of fluctuations that constantly happen in the ecosystem here that are going to change the priorities of where any business, but where a bank is going to be able to focus and earn their revenue in particular. But adding in a sponsorship model is something that is very, very interesting. So we're very open to all of those conversations and are talking to banks that have experience maybe in commercial, that are banking and doing treasury services for some of these types of clients that are sliding into what a sponsorship scenario might look like. And it's giving them accessibility to be able to win relationships for partners that maybe they would never have had access to. So it's pretty exciting to see the net new generation and interest that are coming from banks of all sizes, whether they be on a smaller scale, under 10 billion in asset size, but then also with the banks that are much higher than that and considered those regulated banks that are not covered by the Durbin Amendment. So that's I think the good news story coming out of all of the regulatory pressure that's out there, and the regulation pressure is probably not going to subside, at least in the near future. So my other point that I wanted to make is that we think that the best banks that are taking a strong look at fortifying themselves in this experience of having the regulators come in and have a stronger position is that they're reading all of the consent orders that are in the market to understand where are the gaps, and then using that as a guidepost to be able to measure themselves against what their assessments could include, so that they're trying to find, where are the areas that they're particularly very interested in, and are we strong enough there? And if not, maybe they need to get some consulting help or value-added partners to be able to help them strengthen their four walls.
Makes a lot of sense. Neha, maybe I'll turn to you next. With your experience in building Oscilar's risk decisioning platform, you've seen firsthand the compliance hurdles involved in setting bank-sponsored programs up for success, including being mindful of potential future need for transitions. Could you walk us through maybe some of the compliance complexities that fintechs face and how this also plays out when switching banks, whether due to forced exits or growth-driven transitions?
Yeah, so the recent wave of regulatory consent orders is, in my opinion, causing significant shifts in the fintech industry. And I think it's leading to two main types of bank transitions. The first one is forced exits. So banks are under consent orders, they're required to wind down partnerships quickly. Fintechs are scrambling to find new banking partners while maintaining business continuity. And then there's heightened due diligence from potential new banks that complicates the entire process due to increased regulatory scrutiny. So that's forced exits, but then there's also strategic transitions. Fintechs are proactively moving to banks with stronger compliance infrastructures. They're diversifying risk by establishing multiple banking relationships. They're also focusing on banks with proven track records in specific verticals or use cases. So these transitions have exposed fundamental flaws, in my experience, in traditional compliance approaches. So regulatory findings have highlighted several things, right? We've seen inadequate transaction monitoring across banks' entire fintech portfolios, significant gaps in customer due diligence programs, and also lack of infrastructure to aggregate and analyze risk across multiple partners. So these traditional compliance systems, the problem really at the heart of the matter is they're not designed for scale and complexity of these modern fintech operations. Common strategies like let's just lift and shift these old AML programs or implement really rigid rules-based systems, they often fail in these transitions, and that leads to missed risk patterns and really overwhelmingly high alerts. At Oscilar, what we've done is we're addressing these issues by building really adaptive technology that maintains compliance continuity, adapts quickly to different banking requirements without having to rebuild things. Importantly, uses AI to learn new risk patterns while preserving historical context, and then above everything provides real-time visibility, right? I think the key takeaway is that these consent orders are underscoring the need for intelligent, flexible compliance systems capable of handling these modern fintech complexities. And this really ensures seamless transition, supports innovation while managing risk. And really at the heart of the matter is it's crucial for the future of financial services to operate safely at scale.
Thanks. Lee, data portability and integration are key challenges when fintechs transition from one bank to another. What challenges do you see when operationalizing these transitions, and really sort of particularly around managing the data between multiple partners, maintaining compliance, and ensuring a seamless customer experience?
Ooh, man, what challenges when operationalizing these transitions? I could summarize that in one word, and that word would be files. And I think largely we are working in an industry that is mostly built around files, and everything moves through batch processing. So in and itself, that makes portability very hard. It's rare that we see any kind of true integration when it comes to these systems and the data that has to move between the partners and the processors and then the bank, and then the bank has to reconcile. There's a lot of file movement there, and for us, it's inefficient from what we see. If you study the history of the clearinghouse, right, it was envelopes and paper, and we've at least moved to files. But we're trying to think through what's the next wave, what's the future, and quite frankly, I think the challenges in the industry right now are almost going to push us into something innovative, something different. So I will say we have a lot of customers today that struggle with bringing over a new program. And usually this comes from maybe even a new processor. And in that case, they're unfamiliar with that data. They have to receive that data in some sort of file structure they're not used to. Neha made a great point of this, but if they don't have that infrastructure to bring that data in and restructure it, normalize it, they can't get those transactions or that data out to their AML BSA product or tool like Oscilar that they might be using. So this is where we're trying to add value. We've tried to build schemas and create mappings for every data set that we work with. Our landscape is still somewhat small, but I think, mapped 40-ish, a little over 40 different data sets. We're trying to offer that to banks that are moving to Snowflake, moving to the cloud. The data has to be normalized there to meet these compliance efforts. In that normalization process, we've had a lot of banks receive files, and I'm not going to call out names here, but let's say there's a zip code field and we're looking for a zip code within that field. We might find somebody's name, and it's clearly not a zip code. It's just the wrong object contained in that field. And I think the more that we can provide banks with infrastructure to validate that data, the more they kind of gain that ownership back, can go back to the partners that are providing the data and pinpoint exactly where problems might be upon receiving that raw data. So before you go turn on this fire hydrant of data, so to speak, you're not putting too much pressure in that line that data flows through. The last note I might add on this, so portability and everything, the customers ultimately can feel this impact if the data is not implemented in a timely fashion. When I say customer, that could be the bank, that could be the fintech program. So everybody wants to move fast in a world that's built around files. But right now, I don't think it's the time for speed. It's a time for quality. We're trying to help that speed with providing pre-built schemas. But I think our initial mission right now is let's focus on data validation, improve quality first, and then I think we can move fast.
Makes sense. Thanks. A bit of a common theme amongst all of your sort of initial answers to the initial questions, with a bit of a common thread of needing to level up our infrastructure to support the growth of the market. And I think that's probably going to be a theme as we continue, not just in this webinar, but moving forward. And so for all of you, as you guys think about, or rather as programs transition between banks, there are often these significant tech hurdles. And so from your perspectives, maybe without doubling down on items we've already hit before, but what are some of the biggest tech challenges that you think banks face when are onboarding a program from a previous bank, or when they're unwinding and they can no longer support? We'd love to talk a little bit about how these challenges impact not only an actual transition, but compliance, the data migration. I think you all probably have your unique components of where you see this activity from your end of the market. So would love to dive in there a little bit.
Sure, I can go first, if that's okay. I think the biggest technology challenges banks face during these program transitions really involve these legacy systems, data incompatibility, like what Lee just mentioned, maintaining compliance without ultimately service disruption, right? And legacy systems, the problem is they're outdated core systems. So as we all know, banks operate on core systems that are decades old. They're not easy for data export or even customer transitions. And there's also lack of data portability. These systems lack clean export functionality, requires custom tools just to extract data, and these tools are just coming along, and tools like Identify do that. There are also data translation challenges, like each bank structures data differently. Even basic things like customer risk scores can vary in meaning, which is surprising. But there's also incompatible storage methods, like the anomalous databases versus document stores. But really the consequence is it's really fragmented transaction histories, right? There's lack of context in customer due diligence files, and that's really a big one. Then there's also compliance and real-time monitoring gaps. So both old and new banks must maintain full monitoring during the transition, which means running parallel compliance systems. So if they have problem running one, running two in parallel is even harder. And these teams may have to also manually reconcile these alerts, which increases the risk of oversight. There's also data migration complexity. Lee was talking a little bit about this as well, is ongoing investigations, alert histories, risk patterns must be preserved, and service continuity, right? All this must happen without disrupting customer service, which is actually a huge challenge. And that is where, in my experience, we've taken a fundamentally different approach to solving these challenges. I think ideally, building systems should involve building systems that expect mobility from the very start. These ideal systems should create standardized data models or work with systems like Identify that work across institutions, develop AI that can translate these risk patterns between different bank contexts, and really enable this kind of parallel processing during transitions. Ultimately, I think this isn't just about better migration tools. It's about re-architecting these complex, legacy financial systems for a much more dynamic environment where clients cannot be compromised.
Yeah, that's I might butt in on this, but I think the technology hurdles we run into the most is that all of these banks, the mostly community banks, I would say even all the way up to regional, all their data is in individual silos. And the companies that the banks leverage for lending products and treasury products and even their core, they've all innovated, and they've grown, and those whether they're buying companies to add to their tech stack or whatever it might be, but it's still, everything's still siloed, and that just doesn't work in the world of embedded finance, especially with multiple partners, because you're now creating more silos. And if the bank isn't capable of bridging the gap between those silos from day one, that's only gonna multiply that problem. So we do see a lot more banks these days, I'd say, especially in the last 8 months, moving to cloud solutions like Snowflake, maybe even Databricks. Those are enterprise off-the-shelf tools that help break down these data silos so you can ingest multiple data streams, normalize that data set. It is a very good use case in embedded finance, but I even see traditional community banking market move in that direction, because there's credit unions alike, all these banks that want to have a customer 360 view. They want to understand true profitability across their customers, or if a customer changes an address in a Banno application, does it pass all the way out to Encino? Just as an example, I'd say we're there. The technology is there. Now I think it's the adoption. So I'll leave it at that.
Yeah, so my point of view, maybe kind of putting a bow on this question a little bit, is that we're identifying that there are similar problems to solve for any sort of transition that needs to happen in the market, whether it's somebody moving from one bank to another or adding a second bank or a third bank to be able to help support them. There's so much variation amongst how the various financial institutions might run their business and have value-added partners to be able to help them with their core integration or data validation or their risk and compliance rules and kind of oversight. There is there an opportunity, and I think there is, for more of our partners like Neha and Lee to come in on a standardization a little bit and say, like, we've got this space really nailed down. Yes, there's more beyond just what our fintech and sponsor bank relationships look like, to the Lee's point in community and otherwise, but can we leverage some of those resources so that it does make it easier for us to find some continuity between how one bank and another bank are running a program that is similar for a financial institution or for a fintech that needs that continuity or doing that transition? I think the answer is yes, but it's a matter of like knowing who the right partners are and have those right conversations so you can start understanding, oh wow, I had no idea that you guys existed and could save my time and energy and resources to be able to level up what I'm doing today. So it's an exciting time just to start really understanding what value-added partners can bring to the system.
Yeah. It's a great point. And just I'll add my 2 cents from my perspective, having supported a bunch of different banks and a lot of programs that have transitioned over the last couple of years. Often when you're looking for a bank for redundancy or because you need one because it's an emergency, or you're adding partner bank 2 or 3 because your business is booming, those are often different approaches to the market. But the question of, we work with X, Y, or Z, we love them as a service provider, they're critical to what we do. Will you bank X, Y, or Z? Do you have an integration with them? Do you work with them? Often that can be table stakes because that continuity is really important. And it really is a team sport to be in this space. It's not, there isn't really one party that is driving the business. You really need to be in sync with your various partners. So everything that each of you said makes complete sense from my perspective. And sticking with sort of like the team sport analogy, when programs transition, there really does need to be a lot of collaboration across the sort of various stakeholders, from the program manager to the bank to even those surrounding the bank and the fintech in technology related roles. So I'm curious from you three, I think you're also similarly well positioned to speak to what are some of the best practices that have emerged in the market, whether that's in preparing for transitions, ensuring smooth handoffs, making sure that there is no meaningful loss or hiccups in the transition. Would love it if we could maybe hit on that topic next.
Yeah, I'll go first. So best practices that I've seen is communication, collaboration, for sure. So when we've had a partner who's completely decided that they're going to exit and they're a longtime sponsor and have lots of partnerships, they were a vital part of introducing and helping to make the right alignments for their partners to find a bank that was going to be able to support their use case and be able to transition in the time frame that they needed to do that. So I would say working as transparently and partnership wise as you can, but also not letting too much time get underneath your feet as you're trying to negotiate what it is that you're trying to land in terms of getting onto another bank with pricing and all those things. Although it's very important, but ideally, aligning with someone who's got this future use cases and roadmap strategies that are important for you as you continue to grow, and then leveraging, the best in class vendors that are out there to say, like, we've maybe the bank who's accepting the net new partner has somebody that they can introduce, and they say, well, we don't run those programs as they are today, but we can leverage you and get you on faster if you use Oscilar as an example to be able to get you more compliant and in a safer position as you come on to the net new bank.
Yeah, I'll add to that and completely agree with what you said. Successful transitions, I think, between banks require more than just moving data, right? They demand orchestrating an entire ecosystem of compliance and risk management. First is that this integrated compliance ecosystem, it isn't just about bank-to-bank communication, it's about creating some kind of unified platform where banks, fintechs, tech providers can work together seamlessly, just as Brittany just mentioned. And I see this in my experience, collaboration across a couple of key areas. First is data integration, which is what Lee works on. Real-time data ingestion from multiple sources like transaction processors, fraud systems, KYC providers. That's essential. You need automated data standardization. But the second thing is investigation and case management collaborations, right? So you need these collaborative workflows between banks and fintech compliance teams. You need to share these investigation platforms with clear audit trails. You need very integrated SAR filing, regulatory reporting. And the third thing is governance and oversight, right? You need real-time visibility into this program performance, which is really critical, which is really what's causing the consent orders is, things become stale and, these gaps are exposed much later. We also need, built-in controls for testing and validation. And what's truly powerful is that if we do this, right, banks can maintain this consistent oversight across their fintech portfolio. Fintechs can demonstrate compliance more effectively. tech partners can integrate once and support multiple relationships like what Oscilar does. And at the end of the day, regulators get a much clearer visibility into program performance to hold everyone accountable, right? So this is, an ideal technology, in my opinion, would develop this kind of open platform that connects all stakeholders, not just one in a box. It enables this kind of real-time risk decisioning, provides collaborative tools, and then ultimately, either partners with bills, ensuring seamless integration between these systems. This is really what a successful transition would look like, and that's the future I believe we should all build towards.
Yeah, I'll kind of a brief response here on the collaboration concept. If there are processors or fintechs listening to this call or watching this video later, I'd say the most important thing we see during matchmaking from a collaborative effort is having sample data. So, as a pro tip there, don't expect every bank to be equipped to pull data via an API. Don't expect really any of them to, but if they are, great. But having a sample data file that basically helps with the bank and efforts towards mapping that data is going to take a lot off their plate. Assuming they have a system that can do that. So I think step 2 there would be at the point of shopping programs and partners, banks need to make sure they have the system in place first, so they can land sample data and then validate what the lift might be. A shout out to Oscilar, but we've worked with them, and I think that they've made it very easy, to the point that we see banks maybe keeping the old operational business moving through like a Verifin while they might spin up their embedded finance in some side infrastructure using Oscilar, so they can kind of slowly alleviate and move that business line over. And it's worked really well to kind of run things in parallel for a bit until they're ready to fully transition. We've also, I'd say last note here, we've seen a lot of success with like the Lithics, Marquetas, and Galileos have moved their infrastructure to Snowflake. And when you have somebody distributing data in Snowflake and you have a receiver in Snowflake, you really don't have to ship files anymore. It's a secure data share. And the collaboration around that has been amazing. And we have a ton of good things to say about how Lithic has handled that transition. And again, it all goes back to data quality and data validation. If they can make that onboarding easier for everybody, it's a big win.
Lee, I'm curious, picking up on the point that you made and really the example where you called out Oscilar. So maybe both for both you, Lee and Neha, just maybe a quick off the cuff follow up here. But do you attribute that scenario where you see some banks leveraging what I'll call legacy solutions for their sort of legacy, more traditional business lines and leveraging newer, different technology like an Oscilar? Do you see the driving factor behind that being the fact that a platform like an Oscilar is purpose-built? Or I think maybe it would be helpful to talk for a moment, if I could put you on the spot to do so, as to why you're seeing that level of success and type of integration in those use cases by some of those bank partners.
Neha, you want to go first, or I can take it?
Go first. Yeah, I'll add to it.
Okay.
The risk of not being
I think that the companies and the vendors that these banks have historically used are good at or they're good at what they've always been good at, and that's very traditional business banking. They have not shown signs of adapting to new business models, which in a way is, I don't want to say forced banks, but banks that want to innovate and progress, they need their vendors, they need their technologies to innovate and progress alongside them. So therefore they're actively seeking companies like Oscilar. And what they end up finding out is like the grass is greener on the other side in these kind of scenarios, specifically around AML, BSA tooling. And so we've seen scenarios where that alone, the AML BSA use case, was enough for the bank to make the investment in the infrastructure. They
Mm.
kind of saw the infrastructure as maybe a daunting task, maybe a big lift, right? A lot of people talk about, analytics and data normalization are great, but not if you don't have a use case. Well, Oscilar is a great use case, and the value of that infrastructure goes from 0 to 100% immediately. That's my point there.
Yeah, to add to that, I think completely agree with what Lee said is this, kind of a movement from old legacy to new modern happens in every industry at an inflection point where there's some major innovation happening that pushes the industry forward, right? When I built into Confluent Public, that was digital transformation. All the businesses really valued data and wanted real-time data and no longer data that was days old. This is what is happening with embedded finance, right? Where the banks require, the fintech partnerships to provide modern products. Fintechs require the banks for regulatory support. And the old systems were just not designed for this kind of innovation to happen at a fast pace. That's one thing. And the second thing is there's always a compelling event in every industry and innovation that forces people's hand, that forces the participants in the industry to move to a modern system. And that here, for good reason, has been this regulatory oversight, regulatory involvement to really make sure that consumers are protected at the end of the day. And these are the two reasons why I feel like we are at that point in the industry where that shift needs to happen. And like the third thing is behemoths would move much slowly, right, than smaller, more agile people. So that's what is happening here is the more modern startups that innovate fast, that have the right talent, they're moving really fast. And the older companies have found some success and they're going to stick to what has worked, right, until they realize that it won't work like years down the line.
Thanks. Makes sense. And since you mentioned the regulatory environment, maybe we'll stick there for a related question. So given the rapid regulatory changes affecting this market, the sponsorship and bank partnership market, could we talk a little bit about what proactive steps maybe banks and fintechs should be taking or thinking about taking to ensure that they remain compliant during transitions? And maybe as a follow-up to that, maybe if we could talk a little bit about how tech can help in building agility to handle the evolving regulatory landscape, whether it's new regulation or just a tighter way of operating due to stricter and tighter examination expectations. Brittany, maybe we'll start with you on this one.
Yeah, well, yes, I'd like to go first. So, I mean, what I'll say is that, consent orders are not new. And they're not new in sponsorship, but we've seen this influx that we've all noticed and can't, get our eyes off of. We keep seeing orders that continue to come and we expect that they won't slow down. So there's that shift. But the banks who've been in sponsorship that maybe started in more in the prepaid days in the late 2000s, earned and learned from their consent orders earlier than some of the other banks that are receiving them today. So what was driven out of what the financial institutions being like MetaBank, now Pathward, and the Bancorp Bank was that they did need to double down and invest in the particular areas that were lacking at the time to run a safe and compliant business. And kudos to them for really investing all of the time, energy, and infrastructure to be able to come out of those consent orders best in class. And we'll definitely hope that every other bank that is in a consent order that's in sponsorship will come out best in class as well. But it's with the help of, some of us that are in the business to try and help them align on what the gaps are and identify how we can strengthen them with our products and solutions to be able to do that. But the data integration stuff and the data validation and the AML, BSA compliance, all of that has continued to be something that has to keep evolving over time, and getting the tri-party assessors, or the tri-party regulators, the OCC, FRB, and FDIC having a joint point of view is, I think, helping the more newer entry banks that have joined into sponsorship within the last 5 to 7 years have a better understanding of like, okay, here's, ideally how we want to monitor it. So we should expect that, regulation may continue to get a little bit tweaked, have more rulings and points of view, but out of it, we should be learning from each other and working with one another and telling each other how we can like do better in order to get to a place where we have a very solid ecosystem of bench of players to support the large amounts of volume and activity that we continue to have and that we'll continue to have in the future. So for me, my partnerships with my fellow panelists here are incredibly important for me to recommend to help banks, whether they are or are not getting assessed right now or having some of those hard meetings, to tell them like, here's areas where we've got people who can help you and make sure that you stay strong. So.
Absolutely, and completely agree with that. And Jeff, you also asked about, proactively, what role does technology play in building this agility and to handle this kind of evolving regulatory landscape? And I think that it's important to understand that there are a couple of, big pillars of technology that need to be true to be able to handle this level of agility. The first one is breaking down silos. Earlier in the webinar, Lee mentioned this, is there are lots of silos in banks, and that's actually the first big problem is, the days of separate systems for KYC, transaction monitoring, fraud, they're basically over, right? A unified platform that allows data to flow seamlessly across all risk domains is the need of the day. And a single source of truth is absolutely essential. We all know what can happen if our brain was fragmented in different ways, right? They also need integrated data and compliance tools. So to move beyond point solutions to modern platforms, really need centralized access to data, which is what Identify does really. And then the major thing is AI-assisted compliance operations, right? AI is completely transforming how teams work together to automate routine tasks, to suggest investigation steps, to gather relevant evidence that accelerates that kind of decision-making. I think there's a lot of misunderstanding in the role that AI can play. It doesn't replace humans in the process. It augments and makes them much more efficient. And it's time to invest in technology that can do that. And then there's continuous testing, validation, shifting from periodic assessment when you were forced to do that to continuous assessment, which is much more proactive in nature, right? Technology that allows that kind of proactivity is really important. Giving regulators the evidence of what controls are working, not just, point in time, but a continuous view of things. And last but not the least is just comprehensive oversight and monitoring, right? Creating transparency in all across all stakeholders, really believing in that, but making it true, and having performance dashboards that show the effectiveness of the program in and of itself, right? In my experience, as part of building all this, the key lesson is that regulatory agility, it isn't just about quick changes here and there. It's really about intelligent adaptation. It's about demonstrable effectiveness, right? In today's environment, change is the only constant, and technology needs to be ready for it.
Yeah, I'll kind of close this one out on regulatory preparedness. I think Brittany may have said it earlier, but there's a great point on, first things first, maybe just reading through the consent orders and understanding what and why. Jason Mikula's blog is another good source. He has documented some of this stuff very well. And then I'll share from our perspective, and I'm going to give a shameless shout out to Identify's marketing team, but we have a blog on our website that we posted recently. Comes from direct experience with a couple clients, but there's really 6 steps as it relates to the data and the infrastructure portion of some sort of regulatory exam. Step 1, have a project plan. So have identified this as a project and have a plan around it and be able to show that plan. Step 2, design requirements. So there's going to be some sort of workflow change in how that data moves in the system that supports that. Have that documented. Step 3, have a test plan. So how are you going to test the system and how are you going to show the results of those tests? Step 4, a monthly status and health report. So they're going to want to see that. 5, a RAID log. And then 6, the last thing is a post go live support plan. So if somebody else built this for you, how is it going to be supported after the fact? And that needs to be shown. And if it's helpful, I will link our blog post into the chat here.
It will definitely be helpful. And I wouldn't be doing my job if I didn't also mention that although not necessarily technology related, one of the evolutions that we've seen in the market that plays a lot into how transitions go is what do the program documents say between the program manager and the sponsor bank. And we don't need to get into it in depth here, but there was a point in time not that long ago where there were banks, there were fintech partners that were treating the documentation between the two as a commercial contract. And while it is, there are some very clear regulatory requirements and expectations, many of which are now ultra codified over the variety of consent orders we've seen that lay out the playbook and terms amongst partner banks and their program managers don't always need to be perfectly mutual. And the lack of mutuality might actually be a good thing for the parties to make sure that the regulations and the regulator expectations are followed and that the customers are ultimately treated the way that they're supposed to be treated. So just a quick shout out to the lawyers that are doing their job and making sure that the paper is set up correctly. So with that, we'll turn to our last prepared question, which is really the crystal ball question as we look ahead. And so would love to, again, maybe go around the room and talk a little bit about how do each of you envision the sponsor banking landscape evolving over the next 3 to 5 years? And what should both fintechs and banks do now to position themselves for whether it's market entry or sustainable growth and resilience in what is, of course, going to continue to be a shifting environment?
I think this is my favorite question, but over the next 3 to 5 years, I envision a couple major shifts. The first one I mentioned lightly before, which is AI is going to be the foundation of compliance. It won't just be a feature. It will become a cornerstone. Banks that master this will scale with half the operational overhead compared to their competitors who don't. And in an Oscilar, in our experience, we're already seeing early signs of this transformation, where, as you mentioned, the tech-forward banks are actually seeing that kind of impact. The second major shift I see is blurring lines between banks and the tech companies. So successful banks will embed intelligence in every process. So similar to electronic trading, technology will become integral to the business itself. And the distinction between banking and technology will essentially become less pronounced. And lastly, I think there's emergence of adaptive banking platforms. So instead of the rigid systems that enforce uniform rules across all products, across all fintechs, which just doesn't make sense, there will be intelligent platforms that adapt to various business models, various products. And these platforms will maintain strong controls while offering flexibility, which is essentially a tech problem. It's really hard to build systems with that kind of agility. For banks and fintechs preparing for the future, I think the key question shifts from, hey, how do we comply, to how do we build systems that evolve as fast as the market, right? This is about building frameworks and systems. And this is where we're focused on every day is, how do we not only solve today's compliance challenges, but really build these intelligent systems that can work on their own, right, in a flexible manner. I think the winners in this evolving landscape won't just be the ones that have the largest compliance teams, the deepest pockets, or the most conservative systems. They'll be the ones who seamlessly integrate compliance and innovation, and they power by intelligence at every level. And that's the future I'm excited to have built at Oscilar.
I'll jump in on my crystal ball. I'm very optimistic that all the the infrastructure systems and challenges we've been discussing today, that we've moved through that problem in the next 2 to 3 years, and that banks have invested in their own infrastructure and technology to bridge the gap between those silos. So I see that happening. I think I'm seeing momentum there. We see it at, Pathward, Bancorp, Sutton, Stride, the ones that are doing larger volumes, and I think the ones that follow those will follow suit in their infrastructure. But a big and interesting indicator I'm paying attention to is also the core providers and their moves from legacy infrastructure, Oracle database infrastructure, on-prem hosted infrastructure. Those guys are moving to cloud. It's a long, slow process, but in the next few years they'll be there. And then now that creates this world that I've been harping on, and that's moving away from file movement, and that's now true integrations. There's a difference between passing a file and setting up a schedule, but truly integrating and privatizing the data that needs to flow or be shared between parties. And I think this, I might quote Simon Taylor from Fintech Brain Food, but he talked a lot about headless banking in his recent blog. And I might be, I support that. I think what he discusses just this world where the embedded finance banks are more tech driven. They're reinvesting a lot of their capital to build technology themselves rather than the dependency on others to have that technology. And I think that as, say, core providers move to the cloud and banks become more equipped, I think it'll beat down some of the hurdles in getting there.
I agree with, oh my gosh, everything you guys have said, and I'm excited to hear your take on it from your perspective. Where I see the alignment is we're already seeing a lot of acquisition and mergers and things happening across multiple partners in the ecosystem. So that will continue to happen. But from the bank perspective, 100%, they're going to pull in much of this banking as a service technology component, leveling up their core environment over the next, several years and pull that in-house. So it'll be less tangent outside of their four walls and be pulled inside, which I think is necessary and a good move for all of us in the world of keeping everybody safe and sound and having the right sort of oversight on what it is everybody's doing. But in particular, I think there's going to be more and more swim lane blending. Like I think Neha said, blurring of lines. That's 100% what is going to happen. There's going to be less sort of like traditional model of this type of engagement or use case only fits with these types of partners, and it's going to be more or less how can we solve the puzzle and do it, in the best way as possible, and do it more in the sponsorship scenario versus traditional and commercial banking. So we'll see more names, more banks that are getting more akin and familiar with getting comfortable here. And it's super exciting to see the many opportunities we have ahead of us where maybe embedded payments isn't a thing, and we're going to be able to provide an opportunity to solve problems where there might be something legacy wise that's out there, like a check or cash or wires and those kinds of things. So lots of innovation still ahead for us.
I want to add one more quick thing, because Brittany just reminded me of it, but it is rather uncommon to see a bank receive their settlement and fee data from Visa directly. They can, right? But a lot of them just get that information from their processor. I think there's so much value when a bank is equipped to take their settlement and fee data directly from Visa. It helps and improves just the reconciliation process alone. But I think in today's world, it's challenging for them to maybe unpack that data directly. But I'm excited as well as Visa makes the initiatives there. I think we're seeing more standardization around that process too.
Mm-hmm.
Okay, with that, we've got a couple minutes left here. I don't see any questions in the chat unless anybody has one now, I think we can probably wrap up and collectively say a big thank you again to AFC for bringing us all together, for hosting the webinar, and of course to our panelists, Brittany, Neha, and Lee, and of course your organizations. Great to see you today. Thank you for the collaboration here, and looking forward to seeing everybody soon.